Well, I'm not going to test you on Section 170 dealing with the charitable contribution deduction. I would be remiss if I didn't at least cover it for you so that you would know about it when you enter practice. Now, in some ways, Section 170 is pretty easy because it tells you that you get a deduction for contributions to charity and charitable organization, and that's all well and good. But what makes Section 170 complicated and why it's worth talking about is that how much you're treated as contributing will depend on what kind of property you give to charity or what kind of charity that charity is. We're also going to see that there are limitations on how much a person can deduct every year as a percentage of their adjusted gross income. And that percentage will change depending on the types of charity that they give to. So, for example, if they give to what we're going to call a good charity, and really, in a way, the code section, as we look at it in just a minute, will talk about good charities and bad charities. Doesn't really use those terms, but I use them because it's clear that they favor some charities. Congress favors some charities over the others. So what we're going to see is that the good charities are public charities under Section 501c3, which allows for nonprofit organizations to be tax exempt if they are for scientific, religious, charitable types of endeavors. So, or educational endeavors. So, the University of Mississippi, for example, would be considered a good charity. Churches are considered good charities. Museums are considered good charities. When we talk about bad charities, we're really going to be talking not about really anything bad. It's just that they are private foundations. They are things that have been in the news, whether it's the Clinton Foundation, the Trump Family Foundation. Those are private foundations where the donor gives money to their foundation, and then the foundation makes decisions about which charities to give the property to or money to each year. And because they're completely controlled by the donor, the deduction is going to be limited to a much smaller amount. And we're not going to get some benefits that we get when we give property to more favored charitable entities. Now, I want to point out on the twin page, which you have on the screen right now, there is, and I'll back this up for a second because I think it's worth seeing this. We're going to look at the Student's Guide folder. The Student's Guide folder will give you the entire book. It just kind of works you through how to read the Internal Revenue Code if you're still struggling with that a little bit after you get out of this class and as you enter practice. We really wrote this book as a way to look at the Internal Revenue Code and the language of the code and help people to understand how to read it and how to approach the language. There's some consistent language in the code. The other thing, though, and this is what we're going to look at with Chapter 5. So if you go to Chapter 5, that's going to talk about complex sections of the code. I was pointing to 6. But that's going to talk about complex sections of the code and how to read a complex section. And Section 170 is one of those sections. So I'm going to pull up now Chapter 5, and there's some introductory language there, but we're going to go to Section 5.04, which works us through the charitable contribution deduction. All right, so and you can see this in Chapter 5 and take your time to go through it. Obviously, again, not testable, but some of you will deal with clients who want to make charitable contributions. So, Section 170 does control that deduction. It's a very complex but not hard section. All right, sometimes it's difficult to apply. And we think about the way sections work, and you'll start with Section A, and it says there is a deduction for contributions to charity in the taxable year. But that's all well and good. But we have to know what a contribution to charity is. We have to know how much we contributed to charity. Is the entity a charitable contribution? Is it qualify for a charitable contribution? So I would say, we would ask the following questions as we thought about gifts to charity. And the first thing is my contribution to a qualified organization? Does my organization even count as a qualified organization? And if so, and so, by the way, one way to find that out is very simple. The Internal Revenue Service, if you go on their website, you can look up charitable organizations. And periodically, they will give a list of organizations that qualify as charitable entities. Now, it used to be in a book that they published. Now it's all online. You should be able to search for your particular charitable organization to see if they are a Section 501c3 tax-exempt entity. And there are lots of different kinds of tax-exempt entities, but the ones that are allowed to receive charitable contributions are under 501c3. And 501c3 limits, to some extent, their ability to lobby. 501c3 organizations are not allowed to support particular candidates for office. They're not allowed to endorse a particular party for office. They're not, not to engage in significant lobbying activities. And so you'll hear, the idea that churches will tell you that they're not allowed to preach politics from the altar or whatever, that particular religious organization is using. And that's technically true, that the church should not be involved in politics because it's a tax-exempt organization. In fact, there was something called the Johnson Amendment that said that charitable organizations should not be involved in politics. We are giving them tax-exempt status, and they can't be involved in politics. But that doesn't mean the individual members can't be involved in politics. So, if you're advising a tax-exempt entity like a church, or a university can say to its members, here are some policies that our religious entity supports. You can't say, well, therefore you got to vote for this particular candidate. But each individual congregant or each individual student or faculty member at a university is free to express their own political opinions, even though the entity that they work for or they go to school at or they belong to, if it's a church congregation, even though that entity is a tax-exempt entity. So, there are limitations on what the organization can do. And so that's the first thing. You check to see if this is even a gift to a charity. By the way, the United States government, you can make gifts to the United States government, and they are tax deductible, but that would be stupid because, the idea is that you're trying to save taxes and not pay as much to the government. So, yes, if I give $1 to the U.S. government, I get $1 tax deduction. If I want to, I can do that. And so there must be other reasons. One thing I want to talk about as we go through this is people give to charity for different reasons. And it's not always to get the tax deduction. That's not always the driving force. It's just a nice bonus for a lot of people. The other thing is that the tax deduction, now that we have always had itemized, but now that itemized deductions become even less useful as the standard deduction gets higher, $2,400 for a married couple, $24,000 for a married couple, not $2,400 for a married couple, $24,000 standard deduction for a married couple. That means that a person would have to make substantial charitable contributions, plus probably have a home mortgage deduction, other itemized deductions. So a lot of people in this country give to charity, despite the fact that the charitable deduction really doesn't help them, since their standard deduction will be greater than their itemized deduction. So there are lots of reasons why your clients are going to want to make contributions. But let's assume we have a client that wants to do some planning, and they are looking to leverage the tax deduction as part of that planning. So that's what we're going to be going through from now on, is to think about someone who's going to itemize and is going to be making substantial gifts. All right, so the first question we're going to ask again is their gift to a charitable organization, and what kind of organization? Is it a private foundation? Is it a public charity? Because they'll be treated differently. If it is to a charitable organization, what is their contribution? And that's important, and that plays into the stuff we've talked about in class this year, right? If I make a cash contribution of $1,000, it's easy to say, then that's my contribution. But what if I gave a property contribution to charity? What if I gave a contribution of my Coca-Cola stock that has a basis of $1, but a fair market value of $1 million? I know if I sold that stock, I would have to report capital gain on it. I have unrealized appreciation on that stock. So if, let's say I give that stock to charity, what's my contribution? Is it my basis or is it my fair market value? And if it's my fair market value, that's a great deal, right? Because I'm not going to be taxed on that transfer to charity. But if I can use the entire value of the property as my contribution and potentially as a deduction, that's a great deal. So that's going to be the sweet spot, when we can use appreciated property, the full value of appreciated property to create a deduction. That's something we want to consider. Then also, how much of my contribution is deductible? And that's where we get into the limitations that we're going to see under Section 170. All right, if part of my contribution cannot be deducted this year, can I take the excess contributions to another taxable year? All right, so we've seen throughout this course, whether it's 465, 469, other sections where we can't take an immediate deduction for some reason, that we can carry non-used deductions over to the next year. We saw with capital losses. Capital losses can be taken to the extent of capital gains, but then they can be carried over, to the next year. You can use $3,000 against ordinary income, but any excess charitable losses, and I'm going to keep doing that, any excess capital losses will be carried over. So we see that carryover happen again and again for non-allowed deductible transactions. So one thing I want you to think about is charitable contributions are voluntary. So to the extent possible, you don't want your client making a larger contribution in a year than they can deduct in that year, right? I mean, so if you're going to have an excess contribution, yes, you can carry it over, but you do not want to create that excess if possible. The other thing is, we're going to see with Section 170 that carryovers are limited, right? They're limited. So if you only have, for example, 5 years to use up a carryover and current contributions are taken into account before earlier contributions, then what you want to do is you want to make sure you use those carryovers. I want you to think about this. Let's say I had a client who had $1 million carryover contribution that they weren't allowed to deduct last year. The first thing they should think about is that that's $1 million they can deduct this year without giving anything more. I want to make sure they can take that deduction. So a lot of thinking through Section 170 is planning, cost benefit. If we have a carryover, let's go ahead and take it, because that is a deduction that may go away at some point. It may expire, because carryovers do expire under Section 170. It may expire. But the other thing is, that's a free deduction. They don't have to give anything else. They've already given it in a previous year. All right, so Chapter 5 will take you through a discussion of this. So the first thing is, we're going to look at the way the code is organized. And if you look at, I'm going down to this paragraph here, and I'll highlight it. Boy, this is cool that I can do this on screen, all right? All right, so and it's in track changes, so forgive me for that, but the section headings will help you determine the questions answered. So they do help, but 170A is the allowance of the deduction, and allowed for charitable contributions as defined by Section C. So that tells you what kind of entities you can give to under Section C. All right, your starting point, but you got to go to C, not B, because B provides for percentage limitations. So it tells you what percentage of your gift is deductible, or your total gifts are deductible. And then Section 170E tells you how much you actually contributed. So in a way, once you figure out that you're giving to a charity, 170E, this next section is what we're going to look at. So 170E really is a complex code section. The first question you got to answer is, was the contribution made in cash or appreciated property? If the contribution in cash, then we said that the amount of contribution is what you gave. All right. But if the contribution is a property, it's quite possible your contribution will be the fair market value of that property unless you gave that property to a private foundation, right? And then we're going to see that that might be limited. The other thing we're going to find out too is that it depends on what kind of property that is. So let's say I had ordinary income property. I had inventory that I give to a charity. And for some reason that inventory has appreciated in value. Right? Not really a typical situation necessarily, but let's say it appreciated in value. I've got inventory that for some the market value of that inventory's gone up, and I give that to charity. Well, I'm only going to be able to give my basis as my contribution. So it's only going to be long-term capital gain property that we can give at fair market value. So here's section 170 and what it talks about. And it says the amount of the charitable contribution otherwise taken into account is reduced by the sum of the amount of gain which would not have been long-term capital gain if the property contributed had been sold by the taxpayers fair market value. So what that tells you, though, the converse of that is you get to take fair market value of long-term capital gain property. That is a huge benefit in tax planning. All right. Now, we got to think about our friend depreciation recapture, right? So we do not get to take a contribution deduction for the amount that would have been depreciation recapture. So let's say I give property with an adjusted basis of $30,000, fair market value of $100,000. If that property was all long-term capital gain property, my contribution to charity is $100,000. If, on the other hand, that 20 of that gain is recapture of depreciation, my contribution is only going to be 80. It's going to be the $100,000 reduced by the amount which would not have been long-term capital gain. But I want you to think about that. If I give $1 of cash, I'm going to save, if I'm in the 37% tax bracket, I'm going to save 37 cents in taxes. So that $1 of cash is still going to cost me 66 cents, right, to give to charity. Not a bad deal, because I'm being able to give the charity $1 when really only 66 cents of that gift comes out of my pocket. You know, I'm able to be more generous because of the charitable contribution deduction. Congress is essentially saying, we want you to make these gifts. We will, in essence, subsidize these gifts. We will not tax that $1 given to charity because it's going for a good purpose that maybe we can't even support. We can't support churches, right? And so in a way, charitable contribution deductions are true democracy, because it allows the taxpayer to decide what good causes they want to support. You know, whether it's museums or educational institutions or religious institutions. So that's still a good deal, right? But it still costs me 66 cents to give that $1. Now let's take my Coca-Cola stock. Let's say I got Coca-Cola stock with a basis of $1, fair market value of $1,000. I give it to charity. If I had sold that Coca-Cola stock, all of that would have been long-term gain. I give that stock to charity. I get $1,000 deduction. Now, I know there's some of you out there saying, well, you gave up something that was going to be worth $1,000. It would have been worth $1,000 had you kept it and sold it. But I would have had to pay tax on the gain. So I get $1,000 deduction that's going to save me $370 in taxes at my 37% bracket rate. Because it's an ordinary income deduction when it's a charitable contribution deduction. So I'm saving $370 in taxes on something that I only had $1 basis in. That's a great deal. If we're looking at cost benefit, contributions of appreciated property give your client the best cost benefit, right? Because they're not going to have to pay tax on the gain, and they get the full value as a contribution. So 170E gives us a really tremendous opportunity to plan. All right, so tangible personal property, if the use by the donee is unrelated to the purpose or function constituting it the basis of its exemption. All right, so what we're going to look at is when we go forward with this section, what does that mean? All right, so in the case of a charitable contribution of tangible personal property, so we're not talking about real estate in this case. We're talking about machinery. We're talking about other things like that, tangible personal property. If the use by the donee is unrelated to the purpose or function constituting its basis for exemption. So, for example, if you give a bunch of farm equipment to a church, and the church doesn't do any farming, what is the church going to do with that? Well, it's going to immediately sell it, right? So one concern Congress has is you make a gift to charity, a property that they are immediately going to convert to cash. Should we give you as good a benefit? So if you look at then B, it says, if you give tangible personal property that's unrelated to the purpose or function, what are they going to do with that property? They're going to sell it. You won't have to report any gain on the gift. They're not going to have to report any taxes because they are tax exempt. Or two, or for the use of a private foundation. This is what we're going to call bad charities. This is, again, that think about the private foundations that are in the news, that are often under scrutiny. They are allowable. They're not really bad. They're just not as good as the public charities, the more valued charities under the code. So, or of any patent, copyright, trademark, trade name, trade secret, know-how, software, or similar property, the amount of gain which would have been long-term capital gain if the property contributed had been sold by the taxpayer's fair market value, determined by contribution. So what this says, when a gift of appreciated property is involved, you got to ascertain whether the property would have generated ordinary gain, short-term capital gain, long-term capital gain, all the stuff we talked about in this class. If you determine the property would have yielded ordinary or short-term capital gain, the contribution really is reduced down by that gain, and typically will just be the basis of the property. If you determine that the property would have yielded long-term gain, then the contribution may or may not be reduced by such gain that would have resulted in the property, depending on whether 1B applies. So we go back to that. Let's make some sense out of that. So we reduce by all of the gain. You only get your adjusted basis if you give property to a charity, even though it's long-term gain property. All right, even though it's long-term gain property, you only get your adjusted basis as a gift to the contribution for tangible personal property unrelated to the use by the charity to a private foundation. So again, we're going to treat private foundations less favorably than universities, churches, and public entities, public tax-exempt organizations, or any patent, copyright, trademark, trade name, trade secret. Those are all going to have to just be given at basis. So if we're going to make a contribution of long-term gain property, we're better off giving that to a public foundation, a public charity, not a private foundation. We don't want to give tangible personal property just so that the organization can sell it if it's unrelated to the purpose or function. Now, there's some play there, because let's say I give a bunch of office equipment to a church, and that, yes, that's not related to the basis of the church's tax exemption, but if the church uses that furniture, if they actually put it to use because they needed some new furnishings and you gave it to them, you could treat that as a fair market value contribution and not a basis contribution. You wouldn't have to reduce that by the amount which would have been long-term capital gain. All right, but in any event, so you can see that Section 170E says the amount of your contribution is going to depend on who you give it to and how they use it. So you want to be careful about that tangible personal property. Now, on the other hand, if I give real estate to the University of Mississippi or real estate to a church, and and that has not it's just a piece of land and it's capital asset, all of the value of that property will be my contribution. Right? So now, on the other hand, if I give the property land to a private foundation, I can only take my basis as my contribution. So, the favorable treatment only applies to gifts to public charities. All right? So that's important. All right? And notice that if we get to this paragraph down here, right there, the purpose of 170E1B is to discourage that churning, where you give personal property to charities. They're not going to use it. They're just going to sell it. So here's an example right here. Assume, I'll highlight this so we can look at it, talk about it. All right, assume that Richie Nuvo, a famous art collector, donated his entire collection of wrestling posters to the Wrestling Hall of Fame, and the transaction qualified as a charitable contribution under 170C. Assume they were a charitable organization. And since the posters are related to the charitable purposes of the museum, historical preservation of wrestling artifacts, then they're going to hold those posters for display to the public. So 170B E1B 1 will not operate to force a reduction in the amount of the contribution. On the other hand, a Prissy Proper donated her library, which contained selected works of manners and etiquette. The Wrestling Hall of Fame, then the government would be concerned that all they're going to do is sell the book. So it's really, in effect, a cash contribution by the taxpayer. But since the taxpayer, to make that cash contribution, would have to recognize the gain, it's not fair to allow the taxpayer to take a fair market value contribution deduction, potentially, on property that the charity is going to immediately convert to cash, or fairly soon convert to cash. Thus, Prissy's contribution would be reduced by subtracting unrealized gain from fair market value, and that's going to then typically be basis is going to be your contribution. Other examples of tangible personal property might be a baseball autograph by the Atlanta Braves given to the Catholic Church, or a pickup truck given to the Museum of Science and Industry. But you could establish that both the baseball or the truck are actually being used by the charity. So you can't just always look at it. But typically, if something's totally unrelated, the charity is clearly just going to sell it. You're only going to get adjusted basis as the contribution. So, in a way, when you think about how to approach this, you approach Section 170E, you kind of think about, if-then statements, a series of if-then statements, which, in the early days of computer programming were called branch blocks. And that's why we refer to these as branch blocks in the Student's Guide. So we start and ask, does the contribution consist of appreciated property? If not, then go to 6. If it does, then go to 2. If it doesn't consist of appreciated property, then you're going to get the value of that property contributed. And that would include lost property. So you're going to get the lower of adjusted basis or the fair market value. You don't really want to contribute lost property to a charity in that case. So we're going to look at appreciated property and treat it differently. And what we want to come out with is a situation where we get to take the fair market value as the contribution, and that's the best situation. That dollar Coca-Cola stock basis, where the Coca-Cola stock's worth $1 million. If I can get $1 million contribution and a $1 million charitable deduction, that's a great deal. And the code allows that as long as I give that property to a non-private foundation. All right, with the property of a generated ordinary income. So we're talking now if it's appreciated property and it's inventory, or it would produce short-term capital gain, then we reduce by the amount which would not have been long-term capital gain. So in that case, your contribution will probably be a basis. Or if it was ordinary income recapture, depreciation recapture, then your contribution will be your basis. If it would have generated long-term capital gain, then you got the potential that fair market value is the amount of your contribution. All right, so then you go down and if it's a good charity, then you get to take fair market value as your contribution. But if it's a private foundation, you only get to take adjusted basis as your contribution. Now, on the other hand, even if it's to a good charity, if it's tangible personal property that's not related to the tax exempt function of the charity, you only get a contribution equal to the adjusted basis. You reduce by the amount that would have been long-term capital gain. So, if you gave a cash contribution, then that's going to be the amount of that contribution. And that's where we get to 6. So we work our way through asking all these questions till we get to what type of property did we give, what charity did we give it to. That's going to affect, under Section 170E, how much we gave. That's the first step. Now, the next thing we need to think about is how much of it's deductible. So now we know what our contribution is, how much of it is deductible, and we go to 170B. And 170B is also going to break us down into whether the gift was given to a public charity or whether it was given to a private foundation. And so we're going to have higher limits for cash gifts to public charities, and the lowest limits will be for capital gain gifts, for appreciated property gifts to private charities. So that's going to be the lowest amount of limit that we can deduct in a given year. And really, when we talk about bad charities, we're not really talking about things that are bad. So 170B1B charities are favored by the law. Those are, again, public charities, scientific, religious, educational organizations, universities, museums, churches will qualify under 501c3 as public charities. All right, they're the most favored organizations. All right, 170B1A organizations, bad charities are not as favored. All right, so we're going to see different limitations. And by the way, these have been raised under the Tax Cuts and Jobs Act, and we noted that in the 7th edition of the Student's Guide. But you can look at the percentage. It's all under 170B1B. But just notice that depending on the type of property given and the type of charity the property is given to, the taxpayer is going to be limited to a deduction amount that is at the most, or was at the most before 2017, 50% of the contribution base. And so the most you could take back then was 1/2 of your adjusted gross income. That's the contribution base is going to be adjusted gross income. So the higher the adjusted gross income, the more charitable deductions you could make. That amount is 60% under the Tax Cuts and Jobs Act. That's the absolute maximum you can take. But within that maximum, there are further limitations. So, for example, if all you do is make contributions to private foundations, then that your limitation is 30% of adjusted gross income. So Congress says, well, we're going to limit you even more. Now, as you might expect, when your client exceeds those percentage limitations, that's when we get into the situation of carryovers. So just know that there are limitations depending on the type of charity you give to. The most favored gift is a cash gift to a public charity. The second most favored gift is a capital gain gift to a public charity. The least favored gift is a gift of property to a private foundation. And kind of third out of 4 is a cash gift to a private foundation. So there are going to be greater limitations. And you can read through this section. It goes through 170 and talks about the specifics. All right, so now let's talk about carryovers, all right? Because once you make excess contributions, which you shouldn't do, as a planning matter, it doesn't make sense for your client to give more in a year than they can deduct. They can work with a charity to split their gifts up. I know the University Foundation is happy to take gifts over a period of time, and people can pledge. There's planning involved. This is something your client can actually do voluntarily. So they should not create excess contributions. You need to be aware of the different limitations depending on the type of charity they give to. All right. So, but once you have these excess contributions, then how do they work? All right. Section 170D governs excess contributions, and it says how those are carried over. All right, each of the carryover provisions allows a taxpayer to treat the excess contributions of the current year as a contribution of the same type of property to the same type of charity in a later year. So if you give it a cash gift to a public charity, that's carried over as a cash gift in the next year to a public charity. And if it was a capital gain gift to a public charity, then the excess will be treated in that same category and subject to those same limitations then. Because non-cash gifts to good charities or any gift to a bad charity has a lower percentage that you're allowed to take of the adjusted gross income each year. All right, so each carryover provision allows the taxpayer to treat contributions for the current tax year as contributions of the same type to the same type of charity in a later year. But there are catches. Carryovers can only be used for the next 5 taxable years, and they got to be used in order of time. So carryovers from 2015 have to be used before carryovers from 2014. Otherwise, the 5-year requirement would be nonsensical. So just know that. Know that you've got to use those carryovers. Again, from a planning point of view, you do not want those carryovers to expire, right? Go ahead and use them before you make any new gifts, before your client makes any new gifts. There's an example here, excessive. This is a person who's excessively generous, so that's not so terrible. But I'm pointing in this area here. Assume excessive had 170D1 carryover of $30,000 because she gave excess cash and non-long-term gain property contributions, and assume that 2015 she gave $45,000 to Alma Mater, a good charity. All right, before she can use any of her carryover from 2014, she's got to compare her current year's contribution to 50% of her contribution base. So she only made gifts to a good charity. They were non-long-term gain gifts, so she's going to get to take up to, back then, 50% of her adjusted gross income. But she's got to take current gifts into account first before she can use the previous year's carryover. And she would have to take the previous year's carryover into account against that 50% limitation before she could use the carryover from the year before that. So again, it's bad tax planning to allow your clients to not use their carryovers, and so she doesn't need to make any contributions. What she needs to do is figure out how she can use that, maximize the use of that carryover to the charity, and give whatever is left of that 50% this year to make sure that she's not creating another excess. So, that takes you through the sections. Now, you can make your own flowcharts for sections if that helps you. I think it helps me to think about logically how the code works, how we want to go through a code section. So again, for 170, it makes sense to me to say if something's deductible, I have to know how much I gave, to who I gave it to, are there any limits, do I have carryovers, what happens to those carryovers? And the code does answer those questions if you look closely enough. If you have questions on Section 170, let me know. I just wanted to take you through it because it does involve capital gains and losses, obviously. It involves some good complex code reading as well. Enjoyed having you in class this semester, and any questions you have going forward, even as you enter into your careers, please let me know, and I'm happy to help.